I wasn't planning to go down this rabbit hole. It started as a quick chart check, the kind you do with coffee in hand, half awake, just making sure markets haven't done anything insane overnight. 3 days later, I was still staring at the screen, re-downloading data, cross-checking platforms, wondering how something so obvious could also be completely ignored. Because what happened on Friday wasn't just a crash, it was a disconnect. And disconnects in markets are where the real stories live. You already know the headline, silver fell off a cliff. At one point, it was down nearly 40% from its peak, the sharpest one-day collapse in modern trading history. Financial media did what financial media always does. Dramatic graphics, words like bloodbath, retail traders getting liquidated, leveraged positions blown up in hours, trillions in paper value erased. It was loud, chaotic, and very public. But while everyone was watching silver itself, almost no one bothered to look at the companies that actually produce it. I'm talking about the miners, the businesses with drills in the ground, payrolls, diesel bills, equipment leases, the ones whose profits are directly tied to the metal's price. There's a long-standing pattern here that traders know well. Mining stocks usually move more than the metal. Silver up 10%, miners might go up 20%. Silver down 10%, miners can drop 20 or more. They're leveraged plays on the commodity. It's not a theory, it's a relationship that's held for decades. So when silver plunged almost 40%, miners should have been obliterated. A 60% drop wouldn't have been shocking. 70? Still within the realm of panic math. Instead, the major silver miners ETF fell about 22%. 22. I thought it was a data error. I checked another platform, same number. Different time frames, different chart providers, same story. Silver in freefall. Miners bruised but standing. That's when the question changed from what happened to who didn't panic. Because markets don't move in isolation. And when there's real fear, the kind that resets valuations, institutions hit the sell button too. Risk managers don't sit around hoping things bounce. They cut exposure. Yet here, we had a historic collapse in the underlying commodity, and only a relatively modest move in the equities tied to it. That suggests one thing. Large holders didn't rush for the exits. And that's strange. Think about who owns big mining stocks. Pension funds, mutual funds, hedge funds, asset managers with teams of analysts modeling cash flows down to the decimal. If they believed silver was entering a prolonged collapse, they wouldn't casually hold on. Their job isn't hope, it's risk control. So either they all collectively forgot how their own industry works, or they believed the price action in silver wasn't telling the full story. Now zoom out to the days leading up to the crash. Earlier in the week, policy signals pointed toward a weaker dollar environment. That's typically supportive for precious metals, and traders responded exactly how you'd expect. Money flowed into gold and silver. Momentum built. By Thursday night, silver was euphoric, pushing record levels. Social feeds were full of price targets that sounded more like lottery numbers than forecasts. Then, before the US market even properly opened Friday, the narrative flipped. Suddenly, the tone shifted toward a stronger dollar outlook with leadership expectations at the central bank that didn't align with the earlier messaging. For traders positioned for continued metal strength, that's not just inconvenient, it's a forced unwind. Leveraged funds don't get to wait it out. They sell because they have to. And forced selling doesn't ask questions. It just hits bids. That kind of move can create price action that looks like a fundamental collapse, even when it's more about positioning than long-term value. If you're a fast trader on margin, you're liquidating. If you're a long-term institutional investor in mining companies, you might see something very different, a violent but temporary dislocation. This is where history matters. Precious metals markets have a documented past with manipulation cases. Not theories, not internet rumors, but actual court records. Over the last couple of decades, several major banks have paid large fines for practices like spoofing, placing big orders they never intended to execute to nudge prices in a desired direction. Some traders were even convicted and served prison time. Regulators describe patterns of deceptive trading that spanned years. Does that mean every sharp move today is automatically rigged? No. Markets can be brutally efficient at creating their own chaos without anyone pulling strings. But it does mean we know two things for sure. Large players have both the incentive and, historically, the willingness to push boundaries in thin or fast markets, and short-term price can deviate wildly from longer-term value when positioning gets extreme. So circle back to Friday. Silver's spot price experienced a cascade driven by leverage, crowded trades, and a sudden narrative reversal. Futures markets, where much of the price discovery happens, can exaggerate moves because they're built on margin. When stops get triggered and margin calls roll through, price becomes less about consensus value and more about who is being forced to transact right now. Mining stocks, on the other hand, are valued on discounted expectations of future production and cash flow. Yes, they react to spot prices, but big institutional holders also consider hedging strategies, balance sheets, cost structures, and the fact that a single day's spike or plunge doesn't automatically redefine a mine's long-term economics. If you believed silver at $120 was unsustainably euphoric, but also believed $70 after a panic flush was too pessimistic, you might do exactly what we saw. Sit tight, maybe trim a little, but not stampede out the door. That alone doesn't prove a grand coordinated scheme, but it does challenge the simple story that everything changed in one morning and that the smart response was pure panic. Another layer, liquidity. During extreme moves, ETFs and futures can trade in a storm of volume, while individual equities, especially in a niche sector like silver mining, don't see the same intensity of order flow. Prices still move, but the absence of a full-scale institutional rush can mute the damage relative to the underlying commodities paper market. So the gap between a 39% drop in silver and a roughly 22% drop in miners might not be a glitch. It might be a signal that long-term capital viewed the crash as a positioning event rather than a structural collapse in demand for the metal itself. And that's uncomfortable because it implies two parallel markets. One where headlines, leverage, and emotion dominate short-term price, and another where slower, deeper pockets quietly decide whether the move changes the actual business outlook. Retail traders mostly live in the first market. Institutions can afford to operate in the second. The real takeaway isn't that every crash is fake or that shadowy forces script every tick. It's that price alone, especially over a few chaotic hours, doesn't always equal truth. Sometimes it reflects stress, plumbing, and positioning more than fundamentals. When you see a historic move, don't just ask, how far did it fall? Ask, who was forced to sell and who chose not to? The answer to that question often tells you more about what happens next than the red candle ever will. And on Friday, the people with the biggest, longest-term stakes in pulling silver out of the ground didn't act like the world was ending. In markets, that kind of calm during a storm is worth paying attention to. Let's start with the uncomfortable part. In finance, penalties don't always change behavior. Sometimes they just get filed under operating expenses. When a multi-billion-dollar institution pays a fine, it can land with all the emotional weight of a parking ticket on a company car. Annoying? Sure. Existential? Not exactly. That thought was sitting in the back of my mind when I pulled up a document most retail traders have never heard of, let alone read. It's a daily report from the Futures Exchange, the kind of dry, bureaucratic file that looks like it was designed specifically to put humans to sleep. But buried in those rows and columns is a play-by-play of who closed positions, who stayed in, and who took delivery. And the date on the report I was looking at? The exact day silver imploded. There's a column labeled stopped. In futures language, that means positions that were closed out. If you were short and you stopped contracts, you bought them back and locked in your profit. Simple mechanics, no drama, at least on paper. Then you start reading the names. One major bank's brokerage arm shows up closing a sizable batch of silver contracts that day, not the day before, when prices were euphoric and headlines were screaming new highs, not halfway through the plunge when volatility was off the charts, right near the lows, after a historic collapse had already ripped through the market. Maybe that's skill. Maybe it's luck. Maybe it's just good risk management. But when you see similar timing from several large institutions, familiar names, the same ones that have previously paid heavy fines related to precious metals trading practices, it naturally raises eyebrows. To be clear, a line in a report doesn't come with a confession attached. These documents show activity, not intent. Still, the optics are hard to ignore. Massive downside move, widespread liquidation among leverage traders, and some of the biggest players neatly closing profitable shorts into the weakness. If you're a small trader who just got margin called out of a long position, that feels less like coincidence and more like a magic trick where you're the volunteer who lost their watch. Now add the timing. The night before the crash, sentiment around silver was almost comically bullish. Targets were flying. Momentum funds were crowded in. Then, within hours, the macro narrative shifted and the trade reversed violently. Anyone using leverage didn't have the luxury of debate. They had to sell fast. That kind of cascade creates price levels that aren't about long-term value. They're about who is forced to act right now. If you're sitting on a profitable short with deep pockets and no margin stress, that chaos is an opportunity to close into a wave of desperate liquidity. Again, none of this proves coordination, but it does highlight the structural imbalance between participants who must react and those who can wait. And just as the dust was settling, the exchange stepped in with margin changes. For anyone not living in futures markets, margin is the cash cushion you must post to hold a contract. Raise the requirement and traders suddenly need more money in their accounts. If they can't provide it, positions get cut. Automatically. No speeches, no appeals. After the crash, margin requirements were increased, then increased again shortly after. Then another hike was scheduled. The cumulative effect was a sharp jump in the capital needed to hold precious metals futures. From a risk manager's perspective, higher volatility justifies higher margins. That's the official logic. Bigger price swings mean bigger potential losses, so the system needs a thicker financial buffer. Fair enough. But here's why the timing unsettles people. Raising margins before a market overheats can cool speculation. Raising them after a collapse can intensify pressure on anyone still standing. Traders who survived the initial drop suddenly faced new capital demands at the worst possible moment. If you were thinking about buying the dip with leverage, those higher requirements just made the dip a lot more expensive. The result is a feedback loop. Volatility triggers, margin hikes, forced position reductions. Forced reductions create more volatility. It's not a villain in a control room scenario. It's more like a system designed for stability that can amplify stress during extremes. Still, when you line up the sequence, historic price run-up, crowded positioning, sudden narrative shift, violent liquidation, large players closing shorts into the panic, and rapid margin increases afterward, it starts to look less like a random storm and more like a familiar pattern. History adds fuel to that suspicion. Back in 1980, during the famous silver boom and bust, exchange rule changes dramatically altered how traders could participate, and the market collapsed soon after. In 2011, during another huge silver rally, margin requirements were raised multiple times in quick succession. Prices rolled over hard and stayed depressed for years. Different eras, different players, but a similar rhythm. Rapid ascent, retail enthusiasm, leverage builds, rules tighten, air comes out fast. That doesn't automatically mean someone is secretly orchestrating events every time silver runs. Markets are perfectly capable of overshooting on their own. But it does show that rule changes and margin policy can act as turning points, especially when speculation is already stretched. Now loop back to the miners, the companies pulling metal out of the ground. While paper silver prices were in free fall, mining stocks didn't mirror the panic to the same degree. They fell, yes, but not in proportion to the underlying metals crash. One interpretation is simple. Equity investors, especially institutions, may have viewed the drop as a futures-driven liquidation event rather than a permanent reset in long-term silver economics. Mines don't shut down because of one wild session. Reserves don't vanish overnight. If you believe prices will stabilize above production costs over time, a sharp paper sell-off might not justify dumping the businesses. So you end up with two speeds of market reaction. The leveraged, fast money side gets flushed. The slower, balance sheet-focused capital adjusts more cautiously. To someone on the wrong side of the flush, that looks like insiders calmly watching a fire they knew wouldn't reach their building. To someone managing institutional money, it might just look like discipline in the face of noise. The truth is probably less cinematic than a secret mastermind and more uncomfortable. Modern markets are ecosystems where rules, leverage, and liquidity interact in ways that can consistently disadvantage the smallest, most emotional participants. Big players don't have to predict every move. They just need to survive volatility that wipes out others. Over time, that alone tilts outcomes in their favor. So when you see a crash that feels surgical, fast, deep, and followed by policy shifts that increase pressure on the weakest hands, it's reasonable to ask hard questions, not because every drop is a conspiracy, but because structure matters, incentives matter, history matters. And if you're trading in a system where the rulebook can change mid-game, the most important skill isn't predicting the next headline. It's understanding who gets forced out first when things go wrong, and making sure it's not you. By the third time, you see the same pattern, you stop calling it bad luck and start calling it a system. That's the feeling a lot of seasoned metals investors had watching this unfold. Not shock, not confusion, more like a tired sigh and a quiet, we've seen this movie before. Because when silver collapsed on paper, something else refused to collapse with it. And that divergence is where the real story lives. Let's talk about the miners again, the companies whose entire business depends on digging silver out of the ground. In a true, lasting collapse in silver prices, those stocks usually get hit harder than the metal itself. Their profits are leveraged to price. Their margins shrink fast when silver falls. Historically, they overreact both up and down. And yet, during one of the most violent silver drops on record, they didn't behave like the sky was falling. They dropped, yes, but not like businesses staring at permanent ruin, more like investors adjusting positions, not abandoning ship. Why would long-term capital hold onto mining equities if silver was supposedly repricing into a deep, sustained bear market? One explanation is simple and doesn't require secret meetings in dark rooms. Large investors may have believed the futures-driven price collapse was a liquidity event, not a fundamental one. Paper markets can move faster than the physical world. Mines don't suddenly double their costs or run out of ore because of one trading session. If you believe the long-term demand story is intact, a panic flush in leveraged markets can look like noise, painful noise, but still noise. Now contrast that with what was happening in the retail physical market. While futures prices were printing numbers that suggested silver had suddenly become cheap again, coin and bar buyers were reporting something very different: high premiums, tight supply, and delays. In periods of stress, physical markets often decouple from paper benchmarks. Small investors rush to own tangible metal, dealers raise premiums to manage inventory risk, and logistics bottlenecks appear. That doesn't automatically mean the real price is double the futures quote. Retail products always carry fabrication costs, distribution margins, and surge pricing when demand spikes. But when those premiums stretch unusually far, it does signal stress in the supply chain. Not necessarily a global shortage of silver, but a shortage of readily available retail product at that moment. One notable private mint temporarily pausing sales because it couldn't source enough material over a weekend certainly raised eyebrows. However, it's important to separate refinery and retail bottlenecks from total global supply. Silver moves through a complex pipeline. Miners, refiners, wholesalers, mints, distributors. A clog in one part of that chain can create dramatic headlines without meaning the planet has literally run out of metal. Still, taken together, strong retail demand, elevated premiums, and a paper price collapse driven by futures liquidation, you get a picture of two markets moving at different speeds. The leveraged, financialized side can swing violently based on positioning and margin. The physical side responds more to fabrication capacity and investor psychology. Now layer in the policy response: margin hikes. When exchanges raise margin requirements, they're officially responding to volatility and risk. Bigger price swings mean the clearing system needs a larger financial buffer. That's textbook risk management. But timing matters. If margin increases arrive after a crash, they can feel less like a seatbelt and more like a second punch. Traders who survive the first wave suddenly need more capital to stay in the game. Some can't meet the new requirements and are forced out. That selling can prolong or deepen the move, even if the original shock has passed. From the outside, it can look like the rules change just as smaller players are most vulnerable. From the exchange's perspective, they're trying to keep the system from seizing up. Both things can be true at once. History shows that precious metals rallies often end with some combination of extreme positioning, sharp volatility, and rule or margin changes. We saw it in earlier silver booms. We saw rapid margin adjustments during prior speculative peaks. That doesn't prove a coordinated plot each time, but it does show a recurring dynamic. Leverage builds quietly, then gets wrung out fast. And leverage is the key word here. Most retail traders who got hurt weren't wrong about silver's long-term industrial importance. They were wrong about timing and position sizing. When you're leveraged, you don't get to be right eventually. You have to be solvent today. Forced liquidation doesn't care about your thesis on solar panels, electric vehicles, or monetary policy. Meanwhile, large institutions with deeper capital and lower leverage can ride through swings that would wipe out smaller accounts. Over time, that structural advantage can look like foresight, even when it's simply staying power. So when people say, smart money knew, what they often really mean is, smart money wasn't forced to sell. That distinction matters. Now, zoom out to fundamentals. Silver's role in industry hasn't vanished. It's used in electronics, energy infrastructure, medical applications, and more. Supply growth is slow because new mines take years to develop. Recycling helps, but doesn't fully close the gap when demand surges. None of those realities changed in a single Friday session. But markets can disconnect from fundamentals for longer than most traders can stay patient, especially when futures markets, ETFs, and algorithmic flows dominate short-term price discovery. If physical demand stays firm while futures positioning resets, prices can stabilize and recover. That's a plausible path. It's also plausible that global growth slows, industrial demand cools, and prices take longer to rebound than bulls expect. Both outcomes fit within historical precedent. What's dangerous is certainty on either side. Saying the crash proves silver is dead ignores the structural demand story. Saying the crash proves everything is rigged and a moonshot is guaranteed ignores how complex and adaptive markets really are. Reality usually lives in the messy middle, where incentives, regulation, leverage, and psychology collide. One thing is clear. Episodes like this tend to push more investors toward owning metal outright rather than paper exposure. Every time futures markets experience extreme volatility and margin shocks, some participants decide they'd rather hold coins and bars, even with premiums, than deal with forced liquidations. That shift can gradually tighten the physical market, especially for retail products. Whether that translates into dramatically higher global prices depends on many factors: industrial demand, mine supply, currency trends, interest rates, and investor flows across all asset classes. Silver doesn't trade in a vacuum. As for the bigger picture warnings, margin stress, liquidity strains, sudden policy shifts, those are worth watching across markets, not just in metals. Financial stress often shows up first in plumbing, funding rates, collateral demands, basis spreads. By the time it's on the front page, the move has usually already happened. So the real lesson here isn't panic or load the truck. It's understand the structure you're operating in. Know how leverage can turn volatility into liquidation. Recognize that paper and physical markets can diverge in the short term. Accept that rule changes and margin policy are part of the landscape, not rare anomalies. And maybe, just maybe, keep a sense of humor about it. Because if you don't laugh a little at how wild modern markets can be, you'll just end up yelling at charts at 2 a.m. And trust me, the charts never yell back with useful advice. In the end, the question isn't whether someone, somewhere, made a perfectly timed trade. That happens every day. The real question is whether your strategy can survive the kind of volatility we just saw without forcing you into decisions you'll regret later. Because in markets, survival isn't dramatic. It's quiet, disciplined, and sometimes a little boring. But it's what lets you still be in the game when the next big opportunity, real or imagined, comes along.